Hello, welcome to the Market Cover. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you all for clicking here and giving us a few minutes of your time. As always, we sure do appreciate it. We say it all the time, but we truly do mean it. We're really short and sweet this week and some spillover. Last week, we talked about quantitative tightening and the Fed in a couple of different ways. And this week, we're going to talk about it again because we have the first Fed meeting of 2024, but a couple different points and maybe bring into focus some of the things that they'll be thinking about. And kind of before we drill into that, just some background here. We'll drill into consumer spending, but we got the GDP report that represented or presented the last number for 2023. And what we found is that we had economic growth that was right at 3% for the year. Now, if those numbers don't mean a whole lot to you, the average of the past couple decades, we've been right around 2% growth per year. That's the average. So in a year when we came into it, where everybody was expecting recession, not only did we stay afloat, but we actually had above average growth. Truly astounding. A big reason for that is the biggest piece of the economy, which is consumer spending, has just stayed strong despite the higher interest rates, despite inflation that was waning, but still, elevated through most of 2024. Despite those, we had the consumer clocking in at a 3% rate. The expectation for this year, again, expectations we know can materialize into many different forms. However, there is more signs that they are crimped, and we find that through some of the data that we get from the four big banks and their quarterly earnings release, because Bank of America, Wells Fargo, JP Morgan, right, they hold the bank accounts for a tremendous amount of U.S. consumers, and if not the bank accounts, then the credit cards. And one of the reasons why the consumer is expected to slow this year, there's always a variable lag. Right? When you raise interest rates, it's not like, boom, people pump on the brakes right away. It can take some time for those higher rates either to hit the debt balances we have outstanding or to curb that major purchase when it does come to your doorstep. The difference between what you might have had as a 0% or a 5 or 6, or it can curtail particularly as bigger tick items. So it takes a little bit of time. And so there is that concern that they do begin to slow down. 1% growth is the expectation for this year. And we'll drill into one factor we have here from credit card spending. The yellow piece here shows you spending volume. That is, of course, not a bad thing. That's reflective of higher volumes, higher levels of economic spending by the consumer, of course, is going to lead to higher volume. But you can see the middle part, which are balances. You don't want to see those tick too high because balances that remain outstanding, of course, have interest rates attached to them, not only higher levels of balance, but at higher rates. And that was beginning to weigh on consumers as we close the books and go into 2024. It's going the wrong direction on the last piece, which is the delinquencies on the far right. So this isn't everything, but trending the wrong direction, particularly for lower end consumers. Now, this leads us back into the Fed. How? Because they are very aware of this. One of the very stated goals was to slow down the economy to rein in inflation. Whether or not they actually have that talent or success, it is certainly what they're trying to do and looks to be succeeding in that regard. So they know that. Now they turn their focus to, can they adjust the levers? Can they cut rates enough to get ahead of the pass and maybe ease the consumer from spending too much? So we do not expect the Fed to cut in this meeting here this week, but we do expect some language, maybe setting the table for more to come. And so I'm going to pass the ball to Andrew here because he's got some good insight for what happens when the Fed cuts, if they do happen to go that rate.
Yeah, thank you, Adam. So as Adam said, we get the first FOMC meeting, the first rate decision from the Fed for 2024 this week. And the expectation is the market's kind of all over the place for this year. There's some people that think we're going to get a lot of cuts, possibly 5 this year. Others are a little bit more cautious and think maybe we may only get a couple. The first time the Fed would likely cut would be March. We think that is pretty low likelihood that could happen. We'll find out and kind of really parse through the data and the commentary from the Fed this week. But as we move into a year where there's likely to be at least one probably interest rate cut, we want to start looking at the data. Again, last week we looked at kind of the political landscape for the market, very data dependent. Again, with the Fed rate cuts, we want to be data dependent as we make evaluations for how the market can respond. So the chart that I brought this week looks at 2 different scenarios when the Fed has that first rate cut. One is when there's a recession in that year, and then another one where there's no recession. So the red is when we have no recession, the blue is when we do see a recession over the next year. And you can see pretty stark difference in performance. The big takeaway is if you notice, they both actually are positive. When there hasn't been a recession, and this is data going back to the 1920s, there no recession years have seen an average gain in the Dow by about 24%. Meanwhile, when there has been a recession, we still have actually seen a positive return 12 months later after that first rate cut by 10%. And what's interesting, if you note, looking at the chart, this is all kind of standardized to 1% or to 0%, is that dotted line is when the interest rate starts or when they get the first rate cut. And if we look to the left of that dotted line, is what the market was doing going into that interest rate cut. Typically, the Fed will cut interest rates as a way to kind of stimulate the economy, to, if inflation's under control, kind of provide some more stimulus to the market. And typically, when we do have a recession, notice that blue line going into the dotted line, a lot of line talk. And you'll see that it's been going down. We start seeing the market begin to prepare and starts to weaken going into those interest rate cuts. Meanwhile, when we don't have a recession, we actually see the market still pretty close to near at all-time highs with that red line. And so right now we have the market again at all-time highs, and we'll see if that continues that level of strength into this year, if and whenever we do get that interest rate cut from the Fed. So again, this is something that we were looking into for the next year. Typically, the market does handle these rate cuts pretty well. If there's no recession, like I said, the market has historically, on average, gone up a little over 20%. And even when we have had a recession, that the market still is able to produce a positive return. This is something that we often talk about in our allocation meeting, separating the difference between economic activity and growth and contraction and what the stock market does. While both are important and we do want to be able to be aware of what's going on in the economy, the stock market can have a much different response and different activity regardless of what the economy maybe is contracting or seeing some stalling. It could still actually be a positive year. And this, I think, kind of shows a little bit of that based off what the Fed does and kind of the interest rate environment, as well as if we're in a recession or no recession. So this is something we'll probably be talking about a lot this year as the Fed does start making some decisions. We'll, of course, be keeping you updated on our views and our thoughts and how we think this is going to impact portfolios and the markets as a whole going forward.
Yeah, Andrew, I couldn't help but to notice as you were going through that, you didn't tell us whether we were on the blue or the red line. You left that out.
We'll know after it happens.
Exactly. No, I tease there. You certainly indicated as much. We don't have the economic forecast in our vision because, as we learned last year, even if you have a good idea, it doesn't mean that's what's ultimately going to materialize. And even then, the market could go a different direction even from there.
That's
So
right.
we do appreciate that insight, and we'll look forward to unpacking the Fed meetings when we do get them, and I'll share any insights with you next week. So thanks again for giving us your time and attention. As always, we'll give you a reminder, 800-928-4001. Give us a call if we can be of service, or scan the QR code and book it electronically. Thanks again. Have a great weekend.